Hello, this is Joe Pryor of the virtualrealestateteam.com in Oklahoma City. It's January 2014. I have another message for investors. I've tried to talk in detail about what's really important about factors in making the right decisions in investing in real estate, especially investing in Oklahoma City real estate. It is something I've done for 25 years. It's something where I have studied, I have learned, I have experienced, and have sold over 1,000 single-family homes in the last 10 years to investors. And so what I want to do, though, is I want to talk about one specific aspect of knowing the law of supply and demand. Now, I've said previously in videos and in blogs that Oklahoma City is a set value supply and demand market, and that's really good because those markets are predictable on value. They don't have high highs and they don't have low lows. But let me tell you one important factor that I think is just huge, and it's what separates, I think, outstanding investment realtors across the country and those that really maybe not know everything that they need to know. And that is understanding supply and demand. Now, you know something, I could sell a lot more property than I'm selling, and that's a lot of property, but I could double my production if I wanted to because the investors are out there, both corporate and individual, I want to buy in Oklahoma City, but I don't. And I'll tell you why. And it's because, very simply, if you're in a good market that's appreciating, then two things are going to happen to your investment. Number one, your taxes are going to go up because your values are going up. And second, if your values are going up, then your insurance is going up. So when I do a long-term investment strategy for you of holding for 5 or 7 years, let's say, for instance, and I say, well, look, you're going to get $1,300 a month for the next 5 or 7 years. I'm only going to be really talking to you about your yield in the first year because in the second year to the seventh, for instance, your yield's going to go down if that rent does not go up because taxes and insurance, your expenses are going up, so your yields are going down. This is why you have to err to make sure that there is less demand, is higher than the supply. Now, what we attempt to do and what we base our numbers on with my property manager is what does it take to sell and what do we limit our sales to so that we can get 3 to 5% appreciation in rental. You know, realtors will talk to you all the time about something that's a good buy, that you're buying it at 15% off, and that you're going to appreciate 5% per year or whatever it happens to be, and that's terrific. But what investment realtors don't pay enough attention to, and what you should have, is an appreciation on your rent. And the only way that you can do that is be responsible when it comes to supply and demand. I don't sell anything unless my whole team approves it, especially the property manager. If the property manager says to me, sorry, Joe, we have too many properties there and my numbers support that, or there's enough property that we need, then we either stay out of it or we don't sell more in there. In this way, we protect your investment. So whatever investment realtor you're using in the United States to purchase real estate investment property with, make sure that you ask them, what is your strategy for rental appreciation? It's huge, and it's very, very important that at the end of the 7 years, that you get the yield that you were promised with in year one. This is Joe Pryor of the virtualrealestateteam.com in Oklahoma City, where we deliver traditional real estate values at the speed of technology.